Hello and welcome. My name is Salil Vadgaokar, and on behalf of Assets Banking, I want to talk to you about a matter that is close to our hearts. This is the sale of property and the implications of the taxation around it, whether it is the short-term capital gains tax or the long-term capital gains tax. A property is termed either a short-term capital gain holding or a long-term capital gain holding. The differentiation is that if you hold a property for less than 24 months, it comes under the short-term capital gains holding and is thus taxed at the short-term capital gains taxation. Anything more than 24 months comes under the LTCG taxation, which is the long-term capital gains holding. STCG, or the short-term capital gains, is taxed as per your income tax slab. If you fall under the 20% tax bracket, the sale of property, the proceeds from it is added to your income and is taxed accordingly. Same for anyone who falls in the 30% tax slab. LTCG is charged at 20% minus the indexation that is deducted from all the charges. The best way to iterate LTCG implications is by taking an example. So driving straight into this example, I have bought a house in 2001 for 20 lakhs. Now in 2021, I am getting a buyer who wants to buy the same property at 1 CR. What are the ways now where I can reduce my taxation outgo and the total taxable amount is deducted as per indexation? The government has helped us out with a very important tool called the inflation indexation, which helps match previous buying prices to reduce the outgo in today's price. So suppose, as per my example, I'm getting a buying price for my property at 1 CR. I bought this same property about 20 years ago. How do I now match or value it as per today's standards? The base indexation starts from 2001, which is 100 points. As of today, on 2021, the indexation has risen gradually and today is at 317 points. Now, if we take this into our example, my base rate for buying a price in 2001 when computed today will be 3.17 times 20 lakhs, which is 63.4 lakhs. Now, using these numbers to input into our calculation table, this is how the table looks. The sale price offered for my property is 1 CR as of today. The price which I bought this house was in 20 lakhs in 2001. The estimated or the indexed value as on today will be 63.4 lakhs. There are a few more costs that we can add to deduct from the total sale price. For example, I have made a renovation to this house in 2005. Now, this total value came up to 5 lakhs then. Using the same indexation table, today's estimated value comes to about 13.54 lakhs. Now I add that as well to my deductible. Last, I can add whatever costs that I've faced in selling this house, whether it is the lawyer's fees or the brokerage that I paid and other sundry expenses. So this also, if I say, is about 3 lakhs, now my total table looks like this: 1 CR minus 63.4 lakhs minus 13.54 lakhs minus 3 lakhs. Today's profit that I get is about around about 20 lakhs. LTCG calculated at 20% on 20 lakhs comes to around 4 lakhs. This is my net outgo to the government. Now, since the value of my property is more than 50 lakhs, I will also be charged TDS at the rate of 1%. So at the time of sale of property, the buyer will pay me 1 CR minus 1 lakh, which will go and be adjusted as per my PAN card number. This can later be adjusted at the time of return filing. Is there a way to not pay this LTCG completely? Yes, there are a few exemptions under section 54 that constitute to exemptions against LTCG. One way is reinvestment of your property into another property. Now, when you're selling a property, you need to describe the type of property you have, whether it is residential, whether it is agricultural, or whether it is commercial. If you are selling a residential property or an agricultural property, then you can you can be exempt against LTCG by buying another residential property or another agricultural property. This exemption does not apply, however, in the case of commercial properties. What is the time frame in which you can reinvest this property to avail the exemptions? There are 3 points. The first point is that I could have bought a house 1 year prior to my sale of property. Second point is I have within 2 years to buy a new property. Or the third is if I'm constructing a new residential property on a plot of land, I have until 3 years to finish my construction. If I'm unsure of what sort of property to buy or I need a little more time, there is another scheme called the capital gains account scheme, whereby I can put in all the proceeds that fall under LTCG for the next 5 years. During this time, I can invest whatever money into either a residential property or a constructed bungalow property. Then and only then will my LTCG not be taxable. If suppose I do not make any decision in investment and the money continues to lie in this account for the next 5 years, after 5 years there will not be any LTCG taxable. The only thing you have to remember is whatever interest this fund earns in this account will be taxable as per your IT slab. Suppose I don't want to invest my money into any new property. Now what do? I want to gain wealth, grow wealth, but I do not want to pay my LTCG. We can make use of the capital gains bonds that come under the section 54 EC. There are 4 kind of bonds in the market, namely NHAI and REC, which are the 2 well-known ones. The other 2 bonds are also the PFC and the IRFC bonds. All these have the same kind of features. They have 5-year lock-in. They earn you around 5% per annum, and whatever interest you earn on this is totally taxable as per your IT slab. If I am planning on investing this money to grow my wealth, is there a better way to invest this money rather than just a capital gains bond? Or pay the LTCG and invest in other format such as a mutual fund or stocks and shares? I have taken a growth in a capital gains bonds as an example vis-a-vis a conservative mutual fund that gives me around about 12% per annum to help me calculate if there is a wiser decision that I can take. Continuing from the example that I had taken earlier, where we'd seen that the profit on sale of property was 20 lakhs. Now if we invest 20 lakhs into a capital gain bond for 5 years, my principal invested is about 20 lakhs, like we can see. Yearly interest multiplied 5 times comes up to about 5 lakh rupees. The tax that we pay per year at 30% total tax paid comes to about 1.5 lakh rupees. So my total earnings at the end of the 5 years is about 3,50,000 rupees. If I add this earning back to my principal invested, my total value as 5 years later will be 23.56 lakhs. Let's compare how this investment in a bond works versus paying the LTCG at the beginning and investing it into a mutual fund. Same 20 lakhs, which is my profit on sale of property. I have calculated that my LTCG payable is 4 lakhs. If I pay the 4 lakhs, my principal that I get to invest is 16 lakh rupees. Earning an average return of 12% over 5 years, I find that my growth is about 12 lakh rupees in returns. If I add LTCG to this, I pay about 1 lakh rupees in tax, after which I have left with an earning of say about 11 lakh rupees. Add my earning to the principal invested originally, it comes to about 27 lakh rupees. Now I take a decision to see where is the opportunity available to get better returns for an investment. Here, after this comparison, I can see that even after paying tax, which was tax on LTCG at 4 lakhs plus tax on my investment, I am still earning 3.6 lakhs more by investing into a mutual fund. This for me is a great opportunity. To summarize, let's start with 3 points to keep in mind. The first one is that timing is very, very important. If we spend a little more time thinking about how to move forward, we can find that we have one more option that can be available to us. The second, while calculating your LTCG, keep in mind any renovation or all the costs that are made towards the sale of property. These can also be indexed and be deducted from the total sale value of property. Third and most important is to be aware of other opportunities that are available in the market. Sometimes we can find that even after paying tax, we can earn little more than by using traditional formats of investment. If you wish to reach out for any professional advice, feel free to contact us on our email address or our contact details provided. We have a team of expert financial advisors comprised of chartered accountants, lawyers, and other investment professionals that can help you with any matter regarding finance. If you also feel that this video is knowledgeable, feel free to share with your colleagues, friends, and near and dear loved ones. Also do like and subscribe to our channel so that we can get more videos and more content for your consumption.